All right, Tim, we had a really volatile week, right? Stocks were high, stocks were low, yields hit a new low along with the yuan. What happened?
Well, clearly what this week showed us is that there's just no such thing as the dog days of summer this year, because this is a week when a lot of people would have been kind of maybe taking it easy, and it was not a week to do that. We started off with a very sharp decline on Monday, and really most of the activity on the downside, from what I could read, and I talked to a lot of people the first 3 days of the week, was that there was some index selling. There was a tremendous amount of money going into the bond market for a couple different reasons. And there was also kind of a rush from hedge funds and from a lot of leveraged funds to take their risk levels down a little bit. So they were reducing their positions, and that's where a lot of the supply and a lot of the selling pressure came from. There was definitely what I called real institutional buying, meaning money managers, pension funds, mutual funds, more of your typical cash institutional buyers. And that was really evidenced by the market acting quite well Tuesday during the last 3 hours of the day, Wednesday during the last 3 hours of the day, when we had that move on Wednesday from down 600 all the way back to even. The selling got absorbed both Monday and Wednesday. Those were double low points, almost a little bit of a soft double bottom. But then the institutions were still there. They still had an appetite for stocks. They hadn't used up all their cash in the morning, and they just grinded the market higher. But the big move was on Thursday, when we got through that gap that had been created between Friday's lows at S&P 2925 and where the market really, for all practical purposes, opened on Monday at about 2880. That was a 45-point gap. That's a lot for the S&P. It's almost 1.5%. Thursday, we got all the way through that, potentially very positive if it can be held into next week. Clearly, the Chinese currency situation stabilized a little bit. The bond market did not give back a lot of its lower yields, a little bit, but nowhere near where it started the week.
Why do you think that happened?
I think that you had three central banks, primarily in the Asian region, lower rates. You had some very negative economic report out of Germany Wednesday morning, showing their industrial production down 5.5% year over year, and for June alone it was down 1.5%. People were talking maybe up 2 or 0.3%. So there is definitely concern about the global economy, and rates are most likely going to stay on the low side of what people would call normal. And we're very likely looking at a Fed rate cut, at least at their next meeting in the middle of September.
We also saw with emerging markets, right? Thailand unexpectedly cut their rates. India
Yes,
cut more so.
those were the three banks that cut somewhat unexpectedly. I'm not really sure what their history is of pretty much pre-guiding their rate cuts like the Fed has gotten accustomed to doing over the last decade or so. But it's not something that people were talking about in advance. It wasn't really expected. And on top of the German industrial production numbers, it really caused concern on Wednesday about slowing global economy. But by the end of the day, I think one reason that the market got back all of those losses on Wednesday, by the end of the day on Wednesday, and believe me, a 600-point reversal is a lot for the Dow, 45 points for the S&P, it was a lot, was that it's a very easy asset allocation trade for investors that were in German bonds or European bonds with negative yields, or even in the US 10-year yielding only 1.6%. It's a very easy asset allocation trade for them to shift some of that money into stocks where the S&P 500 is yielding more than that, as long as you don't think that the US is going into a recession later this year and next year.
Well, Tim, like you said, this is not the dog days of summer
Right.
as it usually is around these months. A lot of I'm guessing managers cut their vacations short this summer. What do we have to expect for next week? What are you going to focus on?
Well, next week we're pretty much done. We're maybe 90% done through a second quarter earnings. There's probably a few tag ends to clear up there. And next week we'll start a little bit slow, give people a chance to catch their breath, maybe tack an extra day onto the weekend. But we'll have a CPI number. It's a big week for macro data. We'll have a CPI number on Tuesday. There's no inflation. I don't expect that number is going to be a market mover. But then when we get into Wednesday and Thursday, we're going to have reports from some of the regional Fed reports, the New York manufacturing report, the Philly Fed number. Those have been weak the last couple of months. We might even get a little bit of a bounce there. But I really think the big impact report of the week is the first read of the second quarter productivity report. And the reason is the first quarter productivity report came in at 3.4%. That was the highest reading in close to 10 years. Okay? Now, this is a quarterly report, so we don't get it every month. It's not something that a lot of people talk about. But one of the big arguments or discussion points among academic economists is, can the U.S. economy grow above trend with inflation so low and so far below the Fed's target of 2.0? Now, in the first quarter, that 3.4 productivity report shocked people. And if something 3 high 2s or better comes in for the second quarter, and there'll be a revision to it in a few weeks, but that would give people some guidance that maybe the first quarter wasn't an aberration, and that the market would probably respond to the idea that the economy can grow above trend even if we have very low inflation. Remember, a few years ago, a lot of people said, well, look, this 2% GDP stuff is just going to be the new normal. That's not what we've seen the last year and a half. And a strong productivity report to back up what we saw in the first quarter would be a very positive sign. Just to give you an indication of how important that report could be, in the late 90s, either just before Alan Greenspan left his tenure at the Fed or just after he left it, he said the one thing that he misread during the 90s was how strong the productivity gains had the potential to be. That was during the beginning of the big internet expansion before we had the infamous internet bubble in 2000.
Well, if we beat that number, maybe that's when we'll see bonds come in a little more.
We could definitely see some selling in the bond market if that's a strong number, but we could also see some continued buying in stocks.